So let's take a look at a situation, how it might look. We've got a couple who are 65, going to live till 90. They've got a $2 million house. And if house prices increase by 3% a year over their lifetime, at age 90, the house would be worth about $4 million. It's about as I said, 3% a year growth. Let's imagine they need to take out $150,000 a year for long-term care for a period of 8 years. And we don't know how long it would be, but let's just assume that. So they get a $1 million reverse mortgage at age 78, and it will grow to $2.1 million. And in fact, it won't actually grow to the value of the house until one of them reaches at age 113, just the same as our lady in France. So this would work for them because they don't have to make any payments on this mortgage. Obviously, they've used up 100% of the equity of their home if, in fact, they live that long. But what it has done is it has allowed them to fund the liability. So how could they use that $1 million? Well, they could buy an annuity for $100,000 a year. That's 2/3 of their cash flow. And interestingly, presuming, let's assume this is the husband who needs the long-term care. If he dies after 8 years and she's still alive, she can take the annuity income she no longer needs for long-term care and use it to start paying back that reverse mortgage if she wants. Or she could go to Vegas, might be entitled to that. The other thing they can do is invest the funds. They could just, the $1 million you get is cash. You don't have to buy an annuity. So you could take the $1 million and you could put it into an investment account. But on a guaranteed basis, if you were getting 4% a year, the money would last 8 years. So presumably, if her husband was still around in year 9, she would be dealing with that in a different way. And of course, they could have taken a different approach entirely. They could have taken a home equity line of credit. So the question is, would that be better? Well, financially, it would be. If I take the same amount of money, by age 90, I only owe $1.7 million, and as long as interest rates stay around that level, that would last until age 120. There are some issues here, though. For starters, there are lower rates for home equity loans, and they always will be lower rates. It's cheaper to set up a home equity loan. Basically, it typically costs almost next to nothing. But the problem is the banks can demand payment, and there is a psychological aspect. How do you feel if your parents or you are 92 and you have a $2.5 million mortgage on which the interest is ticking over on a regular basis? That could be a tad stressful. And finally, you might live too long, of course, which is a challenge. So the other question was, can you make the interest deductible? Well, as a matter of fact, you can. Normally you couldn't, but the way you would do it, the way we would do it, is we would actually take the loans or the cash you were getting from these lines of credit, use them to add to your portfolio, and then take other parts of your portfolio and liquidate them for your spending. So effectively what you've done here is you've borrowed to actually buy investments. You haven't actually borrowed to fund long-term care. What about deferring property taxes? This is a great deal. It's available after age 55, so I'm thrilled because I qualify. It's low rates. Currently the rate is 1%. It's registered as a lien on the house. It's paid back at the death or sale of a home. Death, typically for joint tenancy, second to die. And it's a very, very inexpensive reverse mortgage. In fact, I almost think of deferring property taxes as a no-brainer. I have no idea how long this system of very low subsidized loan rates will exist, but as long as it does, it's extremely attractive. So what about insurance options? Well, Patty touched briefly on some of the insurance that she has. In critical care illness, I'm not going to spend a lot of time on the various components, just give you a very brief overview. It's a tax-free lump sum at death. Major issues are covered: cancer and heart disease and stroke and Alzheimer's. Premium refund if no claim. If you're going to buy a policy like this, you do want to get it with a premium refund so that if you don't have a claim, you can get your money back. It's very difficult to get standard rates. I would guess 50% of the people who apply do not get standard rates. It's very tough underwriting. And premiums are really expensive at older ages. Long-term care, tax-free cash flow during the claim period. The maximum benefits are typically around $10,000 a month. You have to continue to prove the claim, and the biggest problem I have with long-term care is after 5 years they can change the premiums, and you have no idea what they could change to, and we'll look at what the issues are there in a second. And on insurance, tax-free payment at death, the rates are guaranteed for life for certain contracts. You can develop ways to create a liquidity event. You can actually, if you will, collect on your insurance before you die to use it to fund these things. You can combine with annuities to create income. One of the kinds of insurance we like the most, and unfortunately is going to be affected by a lot of rate increases, is level term to 100. I'm going to show you a little later how that works, but the main advantage of this kind of insurance is when you measure the return to life expectancy, it is actually a very good rate of return. So there's a way of combining this insurance, especially with annuities, to generate some very attractive cash flows, which would help fund some of those long-term care issues we talked about. These are just some of the few articles, including one that's on our website you can get that was done earlier this year on all of the Canadian insurance companies changing their insurance rates. The reason they're changing their insurance rates is interest rates are so low. The return they get on your premiums has dropped so much, they have to increase rates. The expectation for next year, for example, on level term to 100 policies is somewhere between 15 and 20% a year rate increase. And they already had a 10 to 12% rate increase just this last year as well. This actuary writing on this blog, you might wonder what I have for a life, because why would I be on an actuarial blog? I mean, but yeah, as they say, an actuary is an accountant without a sense of humor. He says, personally, I'm headed out to apply for some more permanent insurance for both myself, and I'm going to lock in some permanent insurance for my 2 teenage children. And he's writing this because he, as an actuary, gets exactly what the value proposition is on this kind of coverage. So the question is it worth the extra expense? So this is somebody who's 50. This is the premium for $1 million of term 100. It would be much cheaper initially for them to buy just straight ordinary 10-year term insurance because they probably don't need it past 65. So for the first 10 years of coverage, they're overpaying, if you want to look at it that way, $9,000 a year. So the question is there any benefit in having a policy after you're, say, in this case, 65, that you can continue with a fixed rate for life? Because you're still paying the premium. Well, we can look at that and we can see how that can be turned into an advantage. So let's imagine you have insurance you bought at a younger age, and at an older age, what we're going to do is we're going to tie it into an annuity. So how might it look? If you're a 65-year-old male right now, you can get an annuity that will pay $71,000 a year of income on $1 million. The problem is when you die, the money's all gone. But if this person is the person we just looked at, and they have this policy they bought 15 years before, they have a guaranteed term to 100 policy that will never cost more than $11,000 a year. So they could just keep the policy, they buy the annuity, and they spend the difference, which is in this case $60,000 a year. 6% cash-on-cash return, net of all costs, and 85% of the income is tax-free because of the way annuities are taxed. This is equivalent to earning 10% on a term deposit that would be fully taxable. This is a great way to increase your cash flow and utilize current insurance to make that happen in the long run. In terms of the extra money, in this case, you paid out $9,000 a year for 10 years. If we had simply waited till 65, and if we assumed insurance rates were not going to go up, which we know they will, if the person could do this today at 65, they would pay $30,000 a year, but they're only going to pay $11,000 when they get to 65 because their plan's guaranteed. So basically, they're investing $9,000 a year for 10 years to get $19,000 a year for life. And that can be measured as a rate of return. It's over 8% a year after tax. So most people don't think of their insurance as an asset or as anything that's going to generate a return. This is a way of making that insurance generate the cash flow which could fund some of those future expenses. So there's the difference between bonds for the same person and an insured annuity, both pre and post-tax. So the differences are huge, considering that the insured annuity is about the same risk as a term deposit from a credit perspective. So the reasons for considering making sure you lock your insurance rates in now is insurability later on affects both life and annuity rates, and in any event, rates are rising, and that's almost certainly going to occur. And then another kind of insurance that individuals will often buy as a savings vehicle is a contract called PAR, or Whole Life PAR, which builds up both a cash value and a death benefit. In this example, this couple has put in $50,000 a year for 20 years, and they just let it accumulate. So now this event takes place. And all they'll really choose to do is say, fine, we're not just going to we're not cashing in the policy, we're going to draw down on the contract. You'll still leave a very significant amount of money tax-free to your estate, but you'll have all the cash you need to fund the long-term care needs. So both kinds of contracts can be really effective long-term vehicles for funding the liability.